owning several properties is not diversification when income, currency, tax, and law all sit in one country.
Two families, both worth $10 million, identical on paper. Then the world turns, the way it always does, and one of them discovers everything they own is trapped inside a single country. The other lives in one place and owns options in five. When the storm hits, one panics and one simply moves. The difference between them was never the money, it was the map. Welcome to Own the World. I'm Kath Kiambao and I'm back with Abhii Dabas. Most wealthy people are certain they're diversified, while almost everything they own still lives inside a single country. He calls that concentration wearing a disguise, and I've been waiting to make him explain it. Hi, Abhii. How are you?
Very well. Thank you for having me, Kat.
So, you say most wealthy people are convinced they're diversified when almost everything they own still sits in a single country. That's a big claim. So make that case for me because these are people who feel like they've spread their bets.
Yeah, absolutely. I think a lot of people believe that if they buy, say, 5 different assets in the same country, it's diversification. Now, owning several properties is not diversification when income, currency, tax, and law all sit in one country. Real diversification is jurisdictional. The honest question is how much of your future depends on a single government, currency, and passport. Now, think about a scenario where, let's say, you had purchased a property in Tokyo or Metro Manila, or let's say Jakarta or Bali or New Delhi or Mumbai, and you had spent that money in US dollars or the local currencies, Indonesian rupiah, yen, Philippine peso. And now, if you look at it 5 years down the line, even if, let's say, your gains have been 25%, but just the currency itself is down from anywhere between 15 to 40%, or even 60% in some cases. So, is that something you can control? You cannot. But what you can do is you can diversify, and you can diversify jurisdictionally. And I just want to add that currency is not the only factor here to consider. Government policy is also a very important one. Now, if you look at the renters reform bill in the UK, or if you look at the new rules for Australian capital gains tax, then you couldn't have predicted that markets become sometimes more favorable, sometimes less favorable. You cannot predict government policy 5, 7 years down the line. But what you can do is you can diversify, and diversify not just by owning 6 different apartment types or property types in the same country, same city. A lot of people do that. And it's not a question of right or wrong, but in these uncertain times, you have to make sure that you're jurisdictionally diversified.
I know that most people believe that that's already enough. You've been investing most of your life, I would say. When did this happen for you? When did you realize that, whoops, I cannot just invest in this one country? Just curious how that mindset started.
I mean, for me, it's always been about exploring. So it was less about investment than exploring new places. And just I like to learn. And while making mistakes scares a lot of people, for me, it's an interesting way to learn. And so, as I always claim, and truly so, that I've made every mistake possible. This week, I'm going through some legal matter for something that I purchased 13 years ago. And then the developer could not deliver. So we are still trying to get that sorted. And
Mm-hmm.
then, but it became more relevant for me because one, I like to live in different countries. I like to spend time in different countries. I look at my life also in a very diversified manner. So summer here, winter in another place, work in another place, where if you need to feel more alive or if you want to feel more innovative, then you move to another country. So I think over the years, that's how it started, more from a personal learning and growth perspective. But from an investment point of view, I think what made a difference for me was while I was spending a lot of time in the same country, actually, whatever the gains were on paper looked very exciting. But when I started spending my money in different currencies, what I realized was even though I might have made 25%, 40% return in a certain currency. But when I'm spending in another currency, let's say a Singapore dollar or a euro, those gains don't look half as attractive as they used to. So that started changing the way I looked at things. And then I just decided that I will try and diversify. And it doesn't mean that you cannot invest in a country with weaker currencies. And I don't want to make it all about currencies, but it could be taxes, it could be the rules, whether it's a landlord friendly market, whether it's residential real estate or commercial real estate, whether it's fixed returns. So there are so many things to consider. But if you are spending your time across different geographies, then you have to create your wealth across different geographies as well.
Yeah, we can probably talk about the currency and other factors in the next episode. So, you've always thought that countries, at some point, you stop seeing them as places and start seeing them as positions, almost like a holdings in a portfolio. Can you walk me through that thinking?
Yeah, it's just the way you look at a certain country. So holding means you can look at the property itself, you can look at, how that asset is doing, but the jurisdiction is important. So for instance, Singapore is stability. London has a very sound legal system. So, it's a safe haven in a lot of ways. Dubai is great for tax and access. And if you want to, grow your business and if you want to create new wealth, Japan is a currency opportunity and quality of life. So when I speak with a lot of investors who are investing in Japan, they're not investing because they are looking at 9% returns. They are investing in Japan because they fall in love with the place and it's a fabulous place to live. There are so many different layers and you experience life in a completely different way. So, if you want a healthy mix of all of those things, then you have to be in different countries. And the US, for instance, is great for innovation. Now, if you just look at these three IPOs coming up, I believe there are 12,000 new millionaires, coming out of these IPOs. So, where will they invest? Now, that is an interesting trend to follow as well. And so, imagine if you are in the market where 12,000 millionaires or a certain percentage of those 12,000 millionaires are likely to invest, then you will see some fantastic gains. So the world is not a ranking table. It's a portfolio. The real question is which role is missing from yours, not which country wins. So if you can find that balance, if you can find that diversified portfolio, if you can build that diversified portfolio, that's a great achievement.
Would you say that once someone starts investing in properties, it's usually with a business objective? So it always starts with where can my money get the highest returns, etc. And then eventually you start realizing, oh, I also want to diversify because of lifestyle or when I want to retire in the future.
Yeah, I think objectives are, very, very important. I think the single most important thing is what's your objective? Somebody asked me recently after my keynote at a conference, they said, what's a healthy return? And my answer was, if you don't regret living in a place and you are happy at the end of the year, that's the healthy return, right? I know it sounds philosophical, but the fact is, if you do not like a country and you have purely invested because you want to grow your money, then even 8% may look disappointing. But if you absolutely love a country and if you love spending time there and the process is a breeze and you know that your property will hold value, then in that case that becomes quite immaterial what your returns are. So we just have to ask ourselves what our objectives are. And so objectives can be wealth creation, wealth preservation, high yields. If you're looking at fixed income every year, if you're looking at minimizing capital gains, it could be estate planning, it could just be lifestyle, it could be your kids' education. So there are so many different objectives. So you have to be very clear about what your objective is. Just like, are you a day trader? Are you a long term investor? Some people
Mm.
talk about stories of them investing in a stock and 25 years later, they had completely forgotten about it. And now it's worth 1,000% or sometimes even higher. And sometimes people just make that kind of gains in a matter of a few weeks when a stock just jumps. I think you have to be very clear about why you're investing, and especially when it comes to real assets, because they are obviously a bit more illiquid than something you could trade on a stock trading app. So you must love these places. Must
Mhm.
One of the rules I have is I do not invest in a place that I don't like. No
Mhm.
matter what anyone says.
Even if there's a high yield or you can earn a lot from rentals, etc.
Yeah, absolutely. Because sometimes there are trends. So you need to understand the difference between a trend and a structural change. So, for instance, some people will say, okay, I know this is a terrible place, but these five things are happening over the next 18 months and it'll become quite exciting. Now, that could be tourism, that could be some big event happening, that could be the promise of some big development coming up or infrastructure being built nearby. A lot of these promises sometimes are not realized. So, a safer way to do that is you just ask yourself, would I be happy investing in this place if none of those trends existed? Then, if they happen, great. But if they don't, you don't regret your decisions, because I've seen a lot of people making this mistake, and there's a lot of excitement and euphoria about some places becoming quite interesting because of an event coming up or tourism. In times of crisis, the first thing that gets affected is tourism. So I'm not saying don't buy short tourism led investments, but make sure that you're prepared for the worst case scenario. That's the way I look at it. And if I feel that I'm happy with that property, that development, then I can assume that a lot of people would be happy. But if I absolutely dread going there, if I just don't enjoy spending time there, if hours of my life are taken up in traffic or navigating the bureaucracy, and I just find the whole system quite difficult, then I'm sure a lot of other people will feel the same way. And that's why if you look at all the wealth hubs, one of the biggest reasons for their success is how efficient they are. So you look at Singapore, you look at Dubai, you look at Hong Kong, and the reason they've been so successful is because they are very efficient. People love spending time there. People love to start new businesses there. They find a way to build headquarters for their businesses there, and that shows in the property values over a period of.
You mentioned some key questions there, and I want to expound on that some more. I know that you've got a 5-part test you run in any country before you'll touch it. And I'm sure you share that also with your friends or for people who are asking your advice. So, can you please give me the 5 questions and then tell me where people usually get it wrong?
Yeah, I mean, you don't have to abide by this rule. That's my rule. I always ask myself the question that if you ask yourself, does this place give me safety, growth, income, lifestyle, and optionality? These are the five things that I ask for. Now, no country or city or town or neighborhood has to do all five, but the more out of these five things it can do, the better investment it appears to me. So, for instance, I had some friends visiting me last week from a country I would not name, and I was showing them around Singapore, and they were just absolutely mesmerized, I would say, by how safe it is, how efficient it is. Something that a lot of people can take for granted, but just the time you arrive at the airport and how little time it takes. I was in a virtual meeting and I had apologized in advance because I said I would be on the move. So my flight landed and I came out of the aircraft and I was on this virtual meeting. And it was a 1 hour meeting. From the time that I uh, came out of the aircraft, collected my luggage, got into a taxi, got home, and I was at my desk, it was about 40 minutes. So the last 20 minutes of the meeting, I actually managed to do at my desk. And that's
Mhm.
efficiency. So you look forward to coming back
That's
to
Singapore for you.
that's Singapore for you. So you have to ask yourself. So safety is very important. There are so many places over the years that I would have absolutely loved to invest, and I still keep looking for opportunities there. But one of the reasons I don't is because I don't feel safe. You don't want to be looking over your shoulder. That's not a good feeling. You want to feel safe. You want your capital to be safe. There are countries where you can make good returns, but then moving the funds out once you sell the property can be challenging. There are countries where, and I don't want to name countries, but there are countries where the proper documentation for your property don't exist. Titles and your proof of ownership can, and in some countries can take quite a few years to reach you, and so that's challenging. And then of course, growth is critical. You have to ask yourself which countries are growing, which cities are growing. That's why there are some places that I really believe in. I believe in the Philippines, for instance. Time will tell whether I'm right or wrong, and many people have written it off, but I just feel it's one of the youngest populations in Singapore, a very educated population. Overseas Filipinos are, they are doing very well. They are spread across the world, so remittances are driving the economy as well. You look at India, the same thing, younger population, not as young as the Philippines. So you have to ask yourselves, in a time where a lot of populations are shrinking and demographics are not very favorable for certain countries, you have to ask yourself, where is the growth happening? So in the US, the growth is happening not because of the population, the growth is happening because of AI. So growth can take many forms as well. But as long as the economy is growing, the chances that your investments will grow are very high. And then, of course, income is an important factor. You have to ask yourself, there are certain responsibilities, there are certain, I would say, hassles, maybe, to say that owning properties in different countries. We are trying to make it as hassle free as possible. Over the years, I have started working with providers that make it hassle free for me, and we are trying to create that ecosystem at scale. So you have to ask yourself how easy it is, and that can it generate enough income. And so you have to always then look at your net income as well. So some countries have very high gross yields, but then when you look at all your expenses, the taxes, the net yields are not very high. And then you ask yourself, you shouldn't I have just invested this money in the stock market or even a real estate investment trust? And so, of course, I'm not comparing the two. It's not a fair a comparison, but it is important. You have to ask yourself, is my money working for me? And lifestyle, that's the next thing we talk about. As I mentioned earlier, I don't like to invest in places where I would not like to spend time. So if I dread going to a place, or if I just feel it's not safe or it's very difficult to navigate, then I would rather not do that. And
Mhm.
some countries are so fabulous. It's such a breeze. They have the right mechanisms in place. When you buy a development, very little bureaucracy, but enough due diligence. So that becomes quite important. And then, of course, you need to enjoy yourself. Even if you're making 3% or 4% returns, if you enjoy yourself, whether it's a ski chalet or whether it's a golf villa, or it could be even a commercial investment or a hospitality investment, as long as you enjoy the lifestyle, you like to spend some part of your year there, then it's a great investment. And the last thing is optionality. Optionality could mean many things, but the fact is, how easy is it to exit? How easy is it for you to find tenants? What the void periods are like? Whether you have many providers to manage your property? If you're traveling, you're in a different time zone, then do you want to receive calls at 3 a.m. that, and again, I'm purely speaking from experiences here, where you receive calls about there's a little fire or something's gone wrong with the electricals, and or there was some damage or there was some burglary overnight, and then somebody's waking up at 3 a.m. and it's not a very pleasant experience at that time. So you have to ask yourself, how easy or difficult is it to manage, exit, or switch to other investments, maybe within the same city or country? So these are five factors that I look for. And as I said, I'm sure there are many, many more. But for me, I can check these five boxes. I'm very happy.
So safety, growth, income, lifestyle, and optionality. But be realistic with me, Abhi. I'm sure that there will always be complexities for each of the country. Do you think it is at all possible to find a way to streamline that process and make it easy? Is that something that you think is gonna happen and it's possible?
Well, I think there's no perfect place. Firstly, we have to accept that. Like, there's no perfect job, there's no perfect person.
Mm-hmm.
And you have to, that's why I say it's an emotional decision, right? So when
Mm-hmm.
you're with your spouse or with your partner, then you don't sort of look at them and say, how many boxes does this person check? So the same thing applies for real estate. For people who absolutely love it, they just love it for what it is. So as long as it gives you options, and one of the options I wanted to mention earlier was also, let's say, residence or second passport. So that's an interesting option as well. So, or does it give you the right to stay in that country or start a business in that country? So I think you have to ask yourself why you're investing, and then you have to just go for it. There's no perfect destination, there is no perfect market. And also, a very important fact is that there is no perfect time. So every market goes through their cycles. So sometimes you catch a market at the towards the end of the cycle, and then that does not turn out to be a very good investment. The market checks all boxes, but you just were too late to the party. So you have to also time your investments. So that's one way of looking at it.
Great. So before we wrap up, if there's one way that our listeners can take away from this conversation, like one thing that they should think of or act on to start diversifying their portfolios, what would it be?
Do a lot of research. I think there's not enough research being done, and that's something you have to find the balance between doing the right amount of research and still pulling the trigger. Sometimes we overanalyze and we miss the opportunities. I've been guilty of that. And
Mm-hmm.
sometimes we underanalyze and we are very excited with the decision that we make. Then we regret because we miss some very, very obvious red flags. I have made that mistake as well. So do the right amount of research, but don't be hesitant. Just go ahead. Before you know it, you'll start building a portfolio. It becomes very exciting. Before you know it, uh, a lot of interesting things about a market would surprise you in a pleasant way. Sometimes people are just watching too much news. People are just so concerned with the headlines. Sometimes I speak with family offices or very wealthy investors, and they just, would not keep an open mind because they just hear a country's name and say, that country is going to hell. Nothing can change. And then it becomes a political conversation. The fact is, no country is perfect, no city is perfect, but no country is absolutely terrible as well. There are always pockets of opportunity. So if we keep an open mind and not just concern ourselves with a lot of noise, then I think that would be a good way to approach investing in our properties. Research, look at what successful people are doing, where smart capital is flowing, where in the cycle we are, and then go for it.
It's the perfect way to close this episode. For most of history, we measured wealth by what we owned, and Abhi's argument is that the next decade measures it by where you're positioned. So the question shifts from what you should buy to where should my wealth live. If you haven't mapped that out for yourself, start there this week. Tell Abhi where your wealth lives today. He's quite active on LinkedIn. Feel free to send him a DM and he'll give you a straight and warm read on where it's concentrated. That's it for today's episode. Don't forget to hit that subscribe and follow button and see you on the next one.